we're just getting started in this housing market recession, and I think it's going to turn into a pretty ugly housing market depression.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for January 31st through February 7th, 2023, while supplies last. This week we feature 2023 Austrian Silver Philharmonics at just $3.29 over spot per ounce. Frequently regarded as one of the most beautiful sovereign coins, the Austrian Philharmonic portrays instruments from the Vienna Orchestra on one side and the grand pipe organ from the famed Augsburg Golden Hall on the other, all in 3/9 fine pure silver with a face value of €1.5. These 2023 Philharmonics come 20 to a tube, 500 to a box, are just $3.29 over spot, and are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me on again. It's good to be back.
Well, it's great to have you. And I've been reading some of the posts on your Investment Research Dynamics blog. And one of the things that really caught my attention is that you're kind of digging into the some of the indicators that people don't necessarily look at for the economy. There are signs that it is deteriorating right now. Can you expand on that?
Well, I mean, when you look at consider the fact that roughly 70% of the GDP is driven by consumer spending. Since the Fed started raising rates, I think it was going to happen anyway, because I think most households were running out of cash or savings anyway before the Fed started raising rates. But, 60-70% of the households right now, there's recent surveys that, show this, Lending Club and a few other outfits, where 65-70% of consumers or households are essentially living paycheck to paycheck. And so that means, they have to cut out discretionary income spending. So you're essentially, those households are essentially, what they're spending money on is everything they need to keep a roof over their head, to keep their car payment current, put food on the table for their kids. So they're, to be fair, they're certainly, the top 10% demographic wealth income, and certainly the top 5% and 1% income demographic, that they still have a lot of money to spend. They made a lot of money from the asset bubble. They still have availability to a lot of credit. Banks are tightening down on credit, and that's probably the key component to what's happening with the economy, is that bank credit is shrinking, and that's probably more relevant than the money supply. Alistair McLeod wrote a fantastic article that everyone in your audience should read it. It's the latest one posted on Gold Money, and that goes into it, and he differentiates between M2 and bank credit, and why it's really bank credit that drives, because when you think about it, I didn't want to go down this rabbit hole, but here we are. When you think about it, what the currency is that you have in your pocket, that you have in your bank account, that's a liability of the Federal Reserve. It's a note. It says right on the bills, Federal Reserve note. So that means it's a liability of the Fed. They've issued the currency, and it's their liability to honor it. And so, every time you engage in a transaction, an economic transaction, it's basically a credit settled with credit, right? Because that's what you're settling it with. You're settling it with Federal Reserve notes. So the key is to watch the expansion and decline of bank credit, and that's what we're seeing right now. And that's part of what the interest rate hikes and the QT is doing. And the QT has just been minimal so far. But anyway, just to kind of circle back, if you look at consumer spending, you look at the big consumer retailers, Target, Walmart, Amazon. Amazon just released their numbers last week. They were horrendous. Their e-commerce business, or what they call their products business, which is e-commerce plus Whole Foods plus another, some more, a hodgepodge of other businesses that aren't related to their cloud business. Their products business for the full year, I think it had like a $10 million or $10 billion operating loss. I think that's the number off the top of my head. And that's before you take into account the write down of their investment in Rivian. So that's why I like to look at operating income. It's a cleaner number than net income. And a big part of that is just slow down in consumer spending. And they're forecasting the slowest growth rate in their business in the history of the company. Or maybe back to 2004. I don't remember. It might be the history of the company, but needless to say, I think it's the history of the company. It reflects the slowdown in discretionary consumer spending. So, and what was interesting about the Lending Club survey is something like 30. Again, these are off the top of my head. I had these numbers in my short sellers journal, I think last week or the week before. Something like 30% of those who make 250 grand or more are living paycheck to paycheck. And part of the reason is you make 250 grand a year. Hey, I want to live like a millionaire. Well, guess what? I can do that. I got access to credit card debt. I got access to home equity loans. I can take out personal loans, and that's your expansion of bank credit. And that's what causes the economic expansion. Well, now these people are tapped out. They can barely afford to service their monthly debt payments as well as their non-discretionary payments, right? Non-mortgage household payments, insurance, medical, you name it. The gasoline, stuff that you need to live every day. That's not, a luxury spending. So that's causing a rapid slowdown in the economy. I think one of the things I had mentioned was semiconductor chips. Well, semiconductors, when I traded junk bonds, that was one of the sectors I traded. So I had to kind of get up to speed on the drivers of the business. And the semiconductors, people like to think, oh, tech's not cyclical. Well, that's actually not true. Semiconductors are just as cyclical as the housing market and the auto industry. And when you think about it, a high percentage of chips get used in automobiles. So when automobile sales decline, which they have been for the last couple of years, or well, not the last couple of years, certainly since the beginning of 2022, that's less chips sales. Automobiles use a lot of chips. We had a big push in technology spending by households, laptops, desktops, webcams, related to the pandemic lockdown and working at home. Well, semiconductor companies, expanded output and planned for that type of demand to be continuous for a while, and it hasn't. It's fallen off a cliff. And you've seen that with, the recent earning reports of Intel, Micron Technologies. Dell just laid off 6,600 people. And, related to that, I think electronics retailers like Best Buy, I think those are fantastic shorts right now because, Best Buy, where it's trading now, it doesn't reflect the fundamental realities of the economy. So, there's a lot of good short ideas out there right now, but that's probably a good one because it's, in my opinion, it's way overvalued here.
I think there's a lot of things that you mentioned that we can dive in a bit deeper. One of the first things I did want to discuss was how the general public right now is tapped out. They have huge amounts of credit card debt. It seems like this is unsustainable. Where do you see this going? Because you can't just continue to borrow credit card debt. The interest rates are incredible on those. So this is definitely not something that can go on forever.
Well, and it's not just the ability of the average household's capacity to take on more debt to keep spending, but there was a bank officer's loan survey that was released, I think either last week or the week before, and banks are tightening down on their issuance of credit, because I think they and this is just, we went through this back in 2007, 2008. I mean, and we started to go into it at the end of 2019. And if you look at a lot of the numbers that I was looking at the delinquency rate on auto loans, and right now it's higher than it was at the peak of the great financial crisis. But it was starting to get up to where it is now back in late 2019, and the pandemic gave the Fed an excuse to print over $3 trillion all at once. And that's basically what saved the economy. And the economy was going to tank regardless of the pandemic lockdown or not. It was headed that way. All the data showed it, housing sales, et cetera. So it's the banks are looking at this, delinquency rates are going up, and it's not just auto loans, mortgages, delinquency loans rates are going up. When I said the delinquency rate of auto loans, I mean, referring to subprime auto loans, because it's become a pretty high percentage of total auto loans. And to be frank, what was considered what's considered subprime now would have been absolute nuclear garbage in the great financial crisis, because lending standards were loosened up so much, especially on mortgages by the FHFA, that there's a certain percentage of loans that are issued as prime rated credit loans, but they're not really. They would have been stamped subprime, 15 years ago. So, like I said, banks are looking at this and they're saying, "Whoa, we're looking at charge-offs, we're looking at loan losses. We gotta tighten down on who we're willing to give money to," and that's what's going on right now.
So, are you saying with mortgage lending, the standards are even lower than they were before the 2008 crisis?
I'm not referring. We obviously don't. Well, I think there are some private mortgage vendors that are doing 110, 120 loan to value loans. They're certainly doing ARMs again. 0% down mortgages. There's hedge funds that were funding that during the tail end of of this current housing bubble. But if you look at the conforming loan is an agency guarantee loan, Fannie, Freddie, Ginnie Mae, and there's a certain down payment requirement. There's a certain debt to income ceiling, and so down payment, debt to income, and credit rating. So first of all, we know that FICO loosened up its credit rating standards. All right. So, if if something below 620 is subprime. Okay. Well, today's 620 FICO is not the same as a 620 FICO in 2005. The person with a 620 FICO in 2005 had a better credit than does that make sense? Than the person with a 620 FICO today. So someone with a 630 FICO would have been called subprime back in 2005. And that's just one part of it. Back then, the down payment requirement for a conforming mortgage, I believe it was 5%. It might have been as high as 10%. But the FHA started lowering that requirement. I think starting in 2015, they loosened up the requirements to qualify for a conforming mortgage. And now you just have to put down a 3% down payment. And in a lot of cases, I could borrow 3% for the down payment from you, right? And then if I qualify in every other respect for a mortgage, I get that mortgage. They don't care that I owe the 3% back to you. That wasn't allowed back then, although I'm sure it was going on. And then the debt to income ratio. Originally, the debt to income ratio was 40%. What that means is that including the mortgage, your total monthly interest rate nut on all the debt that you have can't exceed 60% of your gross income, right? So the income on a monthly basis that you report to the IRS. And now they raised it to 60%, I don't know, 2017, 2018 maybe. And then during the lockdown period, when we had the debt moratoriums, they removed the debt to income limitation. So it may be back in there right now. I have to look it up. But the point being is that a lot of the conforming mortgages that have been issued, say over the last, well, really since 2015, would have been considered subprime, even though they weren't like the garbage countrywide 125 LTV non-document loans, non-income verification loans. But they would have been considered subprime in terms of the credit quality and the profile of the borrower. So that's why, it doesn't matter that we don't have the liar mortgages and, that garbage anymore. But, on average and in general, the overall credit quality of the pool of mortgages in total economy wide is lower than it was back then.
And it does seem like the real estate market has really slowed in the last year or so. Things have slowed, prices have come down a bit, but are you expecting then them to come down a lot farther than they are now?
Well, first of all, there are certain pockets around the country where the market it never really heated up a lot, and so it isn't really slowing down a lot. But especially for the cities that were the biggest bubble cities, I mean, the market's in a tailspin. When first of all, you can't use the Case-Shiller home price. There's a lot of flaws in that, and he used to admit to that back in the first go around of the housing bubble 1.0. He on occasion he would admit that it's got flaws in it, and we don't have to go into that here, but prices in a lot of what were the hottest cities, prices are down anywhere from 10 to 20%, and it's really the transaction volume that is starting to crash. I mean, and if you there's probably about 5 or 6 home builders where I track them every quarter, and I look at their numbers, I look at their deliveries, their new orders, their backlog, and many of these home builders are now their new order rate is below where it was when the housing market crashed back in 2008. I mean, KB Homes, I was just looking at their numbers because I put it in my short seller journal last week. For their latest quarter on a year over year basis, their new orders were down something like 65%. I mean, it just falling off a cliff. And that's for the housing market. That's what you need to look at when you see housing, home builder financials. That's looking into the rear view mirror, because that tells you what was going on in their business, up to the point where the quarter ended. But if you look at new orders and backlog, that tells you where the business is going and what kind of numbers they're going to report down the road. And I just saw an interesting chart, I think it was 2 days ago, and it was the buildup in merchant inventory for home builder materials like lumber and all the other components that go into building a house, and the inventory to sales ratio is just soaring right now, and that tells you the home builders are sitting on a lot of work in process inventory that was originally under contract. Contracts have been canceled. Cancellation rates are now higher than they were when it was at its worst in the great financial crisis, housing collapse. And so these home builders are looking at a situation where they're gonna have, I think the number is something like 1.7 million homes in unfinished inventory and work in process. And at some point, they may stop working on a lot of these homes, but ones that are almost finished, they'll finish them and put them on the market and pray. But what's going to happen is they're going to have to really drop their prices to try and move that inventory, and that's going to filter into the existing home market. So we're just getting started in this housing market recession, and I think it's going to turn into a pretty ugly housing market depression. And I say this because I've been following the housing market since early 1990s. That was another sector that I traded when I traded junk bonds. So I've always been interested and fascinated by the housing market and what drives it.
as we're seeing this all play out in the housing market, we're seeing the stock market roll over. 2022 was, the first year down for a while. But yeah, I'll just share your chart here that you have on your website. Equity exposure is really disconnecting from investor sentiment right now. So can you expand on why that is bad for the stock market right now?
First of all, for a few months now, probably 3 or 4 months at least, maybe longer, there's been this narrative out there, social media, um, stock market analysts, the sell side stock market analysts, blah blah blah, where they're saying, well, this sell off that we've been in since the start of 2022 and really late November for the Nasdaq of 2021. Now investor sentiment's looked at as a contrarian indicator. So when it's low, that's supposed to be bullish for the stock market, and when it's unusually high, that's supposed to be bearish. Well, for quite some time, investor sentiment has been at the low end of historical norms, and so perma bulls are pointing to that and saying, "See, we're going to have to rally because of this." Well, no, that's not necessarily true, because if you follow the money, as the famous phrase goes, you follow the money, the percentage of allocations that retail investors and a lot of institutional investors have to equities is well over 60%. And it's not at the highest range that it's been, say, in the last 20 years, 25 years, 30 years, whatever. But it's at a very high level. So even if people are worried about the stock market, they don't feel good about it, they're not voting that feeling with their money. They're leaving their money in the stock market. And so that's why you got to be careful with these sentiment measurements right now, because they don't really reflect the true view of the average investor out there, professional and non-professional, towards investing in stocks. And I saw a chart within the last week where it showed in the investor allocation over time, and it went back to, I think, 98. And so if we're in the 60% range as a percentage allocation toward equities in an investment portfolio, when the market bottomed out in 2002, I believe we were like in the high 30s in terms of, and that's, again, I'm reciting these numbers from memory, but it was that type of range between, a high allocation of your portfolio to stocks versus a low allocation of your portfolio, where the way you're voting your money really reflects how you feel about the stock market. And we're not even close to that yet. So, I don't think anyone can talk about a market bottom until the amount of equity that investors have allocated, or the percentage of their portfolio that investors have allocated to equities is close to cut in half from where it is now.
Now, another chart you showed that really explained why right now, in your opinion, when based on off this data, that precious metals are undervalued right now, is the M2 money supply compared to gold.
Yeah, I was looking at a chart of that. This is just the In Gold We Trust US M2 to gold ratio, and they take it from the current time, the present, all the way back to 1970. And when the ratio is historically high, at a high level, there's a lot more money relative to the price of gold floating around the system. And so, like, for instance, when the bull market in precious metals started in late 2000, early 2021, or early 2001, the M2 to gold ratio was almost 20 times. And then when the market had a cyclical bull peak back in 2011, that ratio had fallen all the way to 5. And, just eyeballing it, the average ratio over the last 50 years is around 12 or 13 times. And it's turning down again because the money's, M2 is shrinking right now. And the price of gold has been going up. It's a little under 12 times right now. at the peak of the precious metals bull market at the end of 1979, early 1980, that ratio got down to 3. So we have some price point targets here for where the ratio could come in before, you can consider the money supply to be under control relative to the value of gold. And, if it comes down to, it gets back down to where it was in October of 2011, we're looking at a double in the price of gold from its current price. So relative to the money supply, gold's not excruciatingly undervalued, but it's certainly, it's not even close to being fairly valued or overvalued. What I like to look at is the gold to SPX ratio chart, and I've got one that goes back to, it just goes back 20 years. I was lazy when I made this chart. So, but we're basically relative to the value of the S&P 500. Gold is at a historically low level, not the lowest level that it's been in the last 20 years, but one of the lowest levels. And so again, this is just another metric that I like to look at to gauge where I think the next move in gold is going eventually. And, according to this, either the stock market's going a lot lower if gold just stays where it is, or the price of gold is going to move a lot higher as the stock market continues to go down. And, we saw there's been periods like that over the last 20 years, probably most notably late 2008, when the precious metal sector took off at the end of October. GDX more than doubled between the end of October and the end of the year in 2008. And the S&P was still headed south, and it didn't hit a bottom until March of 2009. So, relative to the stock market, I think we can look for gold and silver to outperform equities by a considerable amount going forward. And I'm not saying it's going to happen next month. I'm talking about over the next year to 2 years at least.
Now, if we do look at the short term, we have seen a rally in the last few months, but a pullback in the last couple of weeks. What do you make of kind of the recent price action we've seen in the metals?
Actually, the pullback didn't really get started until about a week and a half ago. The market started rolling over, and I've been looking for a corrective pullback in the sector. I went out saying, 2 or 3 weeks before it started rolling over that, we need to have a corrective pullback. And I don't want to get into the obvious official price management or the invisible hand of the Western central banks helping guide the price of gold lower with the help of the banks. Just in terms of straight technicals, without that manipulation element involved. The sector had gotten a little bit frothy. GDX was up 42% between the end of September and the end of 2022. That's a big move. And I don't want to see it go straight up like that. I want to see it I'd rather see it like take off like an airplane takes off, and then maybe toward the end of a bull cycle, do a rocket ship move, and launch. But it'll be much healthier if we get a pullback. And, GDX and I believe GLD are now below their GLD as a proxy for gold. Well, gold's right at its 50-day moving average. GDX fell below it yesterday. Actually, 2 days ago, I went further below it yesterday. And, historically, when we've had cyclical bull moves since 2001, occasionally after a big run up, you get, what I would call either a 50-day moving average correction or 200-day moving average correction. And, the jury's out now whether the sector will go all the way back to its 200-day moving average. But even if it pulls back to the 200-day moving average, we've still had a really nice move since the fall of 2022. So, and to me, a pullback like that would take, it would wring a lot of the over bullish sentiment out of the sector. And it would also set the sector up for a monster move higher at some point, and again, I'm not going to put time frame on that. I think, I think that, I'd be willing to say that between now and the end of the year, I think that the mining stocks and gold and silver will be quite a bit higher in price than where they are right now. Again, it's just kind of a question of what the catalyst will be that'll trigger the next monster move higher. I think, especially if the stock market continues to go lower, which I'm 99.5% sure it will, at some point, there's going to be capital that comes out of the stock market, and it's going to look for places to reallocate. And again, if for any mutual fund that's based on value investing, that's probably a dinosaur strategy, value investing, but these days. But you have to look at the mining stocks, because again, all the data that I look at shows that the mining stock sector relative to the rest of the stock market, relative to treasury bonds, the mining stocks are historically undervalued right now. Not the most undervalued they've been, but they're historically undervalued. So I think, and we saw that happen in 2009, 2010. There were some big mutual fund complexes like Fidelity, where their macro large general investment funds started buying a lot of mining stocks. I think we'll see that again.
All right. Well, Dave Kranzler, really appreciate your time today. Any last thoughts before we let you go? And did you want to share with the viewers where they can find you?
Sure. I guess in terms of last thoughts, I would just say, if you find yourself hoping that the Fed's going to cut interest rates, you got to change the allocation of your investment portfolio, because it means you're thinking that a Fed interest rate cut or a pause in the interest rate hikes is going to save the stock market and save the economy. It won't. We're in the part of the economic cycle now where it just has to play out, and I don't know how long it's going to last. But the more the Fed tries to kick the can down the road, the worse it'll get down the road. So, I would suggest taking a lot of the risk out of your investment portfolio. And right now, coin dealers seem to be a bit heavy on inventory and premiums are low. This is a pretty good time to start buying more physical gold and silver, or start a position in physical gold and silver that you take delivery yourself and safekeep it yourself. But at any rate, my website is investmentresearchdynamics.com. And I've been a little bit lazy about putting new posts up recently. I've got a new one on Amazon.com about ready to go as soon as I get it edited. And it's an excerpt from one of my short seller journal newsletters. And then there's information about both my newsletters on my website at the top.
Fantastic. Dave, once again, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.